So I had lots of requests for me to go through some of the multiple choice questions. This first bunch came from the June 2019 paper 1. So just a reminder here about the correct method, make sure you colour it in, don't do these wiggly lines or anything else. If it's wrong, put a cross through it. If it's previously got a cross through it but now you think it's right, put a circle around it. Okay, so what does a statement of affairs show? So remember, we do this on incomplete records questions where we're trying to find out the opening capital. So it's not to do with how much cash has flown into and out of a business. It's like a mini statement of financial position. It doesn't show how well a business does compared to its competitors. It certainly doesn't have anything to do with taxation. It's the value of a business's assets and liabilities at a point in time. So it's built on the accounting equation, assets minus liabilities equals capital. Question 2, which one of the following will not affect a statement of cash flow? So we're looking for something that doesn't appear in a statement of cash flow. So bonus issue of ordinary shares is screaming at me as the obvious choice here. Remember, a bonus issue means that no money comes in or out of the business, but let's just check these ones to make sure. Redemption of a debenture, that's where we repay a loan. That most certainly will affect the cash flow. Repayment of a loan is the same as a debenture. And then the sale of non-current assets will bring money into the business. So that will definitely affect the cash flow. Okay. Question 3 then, following a recent stock take, it was discovered that some inventory had not been included in the physical count. What would be the impact on profit and current assets when the business accounts for this inventory? So it's very straightforward. When we increase the inventory figure, profit goes up as well. So inventory is in current assets, so they will increase, so will the profit. So we're looking for profit increases and current assets increase. It has to be D. I'm not even going to bother with the others. Which of the following is treated as an outflow on a reconciliation of operating profit to the net cash flow from operating activities? If you're one of my students or if you've watched one of my cash flow videos, this is the penguins in drunk dinosaurs bit. So which one of those is treated as an outflow on a reconciliation? So we start with the operating profit and we add back things like depreciation, loss on disposal, and then we adjust for inventory, trade receivables, trade payables. So we're looking for an outflow, a negative. So which one of these is bad for cash? Well, decreasing inventory is actually good for cash because if we hold less inventory, we're paying less out. Decreasing trade payables, that would be my suspicion here. I'm going to colour in B. We'll check the other two just to make sure. But if you pay off your trade payables and reduce those, that's bad for cash. So it's going to be an outflow. So a decrease in trade receivables is actually an inflow on the reconciliation of operating profit to net cash flow from operating activities, because if we've decreased trade receivables, they've paid us. So that means that the cash situation is improved by that. Depreciation of non-current assets, remember, is added back because it reduces profit, but it doesn't reduce cash. So it's not really an inflow as such, but it certainly isn't an outflow. Right, let's move on to the next question then. The following information is available for rent receivable for the year ended 31st of March 2019. So rent receivable, remember, is income. So we've got a credit balance brought down at the 1st of April 2018. So this is money that was received in the previous year and needs to be included in this year. We've received via the bank account £7,000. We have some information about the monthly rent charge here. So rent receivable ought to be £6,000 in the income statement. And it's asking us, how is the balance on the rent receivable account at the 31st of March 2019 shown on the statement of financial position? Well, we've only got the balance on the 1st of April. So what I'm going to suggest here is we do a little rudimentary T account. So the balance brought down is £200. So this is rent receivable. The amount received via the bank account, so the bank, we debit the bank, we credit the rent receivable account, £7,000. The amount going off to the income statement is £500 times 12. So the income statement is £6,000. The balance carried down is going to be the difference. So we've got 7,200 on that side. That means if we take the 6,000 off, we've got £1,200 carried down at the end of the year. So brought down, it's going to be rent that's been received in advance, so that's going to be treated as a current liability on the statement of financial position. So the answer for number 5 is D. Current liabilities, £1,200. Okay, so this is prepaid income. So remember, prepaid expenses are current assets, prepaid income, current liabilities. Right, number 6, an item of inventory which originally cost £50 can be sold for £70 after being repaired at a cost of £25. How much should the item be valued at? So this is a lower of cost and net realisable value. Remember to always ring fence the cost. Don't be tempted to do anything with that, and then compare it with the net realisable value, which is £70 minus this £25 that we're going to have to pay to get the thing repaired. So the net realisable value is only 45. So that's the value we should use. We only use net realisable value when it's lower than the cost. Okay, number 7 then, which is the correct formula for trade receivables days. So it's trade receivables over credit sales, not times 100, but times 365. So the answer for number 7 is going to be B. I'm not even going to look at the others there. We just need to know the correct formula. Remember, it can never be anything times 100 if it's days. It needs to be 365. So it's got to be one of those. Don't put it over total sales. That will skew the result. If it's available, we should always use credit sales for that formula. Right, it says here, an accounting standard can be ignored if the net impact of doing so has such a small impact on the financial statements that a user of the financial statements would not be misled. Which accounting concept does this wording best apply to? Okay, so it says we can ignore the accounting standard. So is it accruals? Is it going concern? Is it materiality? Or is it realisation? I think the accounting concept they're referring to here is going to be to do with materiality. So I think the wording here is not particularly brilliant, but it's nothing to do with the accruals concept. Accruals is where we're matching income and expenditure for the year. Going concern concept is the presumption that the business is going to continue to trade for the foreseeable future, and if it isn't, we need to adjust the value of assets downwards. And realisation is about the timing of transactions. So it can only really be materiality for number C. So this is about the size of an adjustment. So if it's not material, we can ignore it. But to be honest, I'm not really sure about that question. I think it's not very well worded. Anyway, number 9, a business is intending to raise finance in order to expand. Which of the following sources of long-term finance would not increase the capital gearing ratio for the business? So we need to know the capital gearing ratio. It's debt, which is non-current liabilities, over capital employed, which is the non-current liabilities plus the equity. So if we don't want to increase gearing, we need to increase the equity of the business. So we need to look down here and think, well, which of these are debt? That's debt, that will increase gearing. Debenture is debt, that will increase gearing. So will a mortgage, also debt. Ordinary shares is going to be the answer there. So ordinary shares will increase equity, but it won't increase the debt of the business, the non-current liabilities. So it will actually end up reducing the gearing ratio. And then question 10, a cheque received from a trade receivable has been dishonoured. So this is where it's been bounced. Which is the source document for this transaction? So if we've got a dishonoured cheque, it's going to bounce back into our bank account, and the bank statement is actually going to be the source document for that particular transaction. Cheque counterfoil is when we pay by cheque. Credit note is when goods are returned by a customer to us, so returns inwards would be the credit note there, and a paying instant counterfoil is when we're paying money into the bank. Okay, so that's 2019's multiple choice questions done, and I'll try and record some more videos with some of the other years. Thanks very much for watching.